Hello, I'm Mark Nickel, President of Baird Trust, and today I'm joined by my colleagues Andy Means and John Watkins. Andy and John, of course, are the lead portfolio managers of our large cap equity strategy, which is the flagship strategy here at Baird Trust. Today we wanted to give Andy and John a chance to address our clients and our financial advisors to give them an opportunity to further unpack our approach to investing, to continue to tease out how we think and act differently, and how that has led to the exceptional track record of large cap equity. Andy, John, welcome.
Hey, Mark.
John, the large cap equity performance numbers have been outstanding for over 30 years. Can you tell us some about the important takeaways that come out of that performance track record?
Well, I think it's important to start with the fact that we have one singular investment objective, and that's to substantially outperform the S&P 500 over full market cycles. Our focus is on the long-term compounding of our clients' wealth, not the short-term ups and downs in the stock market. We strongly believe that the short-term fluctuations in stock prices is not in our control, but the long-term is in our control if we do our job well. So we think that the longer the time period of measurement or evaluation of our performance track record, the better. The other thing I would mention is that we tend to do well in tougher times. So in those down markets, if you look over the 30-year history of the track record, there have been 6 calendar years where the S&P 500 declined, and we outperformed in all 6. And that's really a function of our investment philosophy, our process, our focus on downside protection, and just the high-quality nature of the businesses we own.
All right, this is to both of you. What is it about the large cap equity investment process that has led to such exceptional returns? And maybe if I'd even say it a different way, what is the secret sauce? Andy?
I think the most important differentiator for our strategy is that we take a long-term business owner approach to investing. In a world that is populated mostly by stock traders, and what underlies our approach is the fact that most concentrations of wealth in the United States are the result of the long-term ownership of a successful company. So what we're trying to do is harness that power of compounding that occurs in a successful company and let the businesses compound our clients' wealth over very long periods of time. Another differentiator that I think is important is that we get no information from stock price movements. We get all of our information from the business results that companies produce every quarter and report on. So what we're focused on are intrinsic values of businesses as opposed to stock market values. Intrinsic values are created by the cash flows that businesses generate, and they tend to be more stable and more predictable than stock market values, which are affected by a myriad of different factors and some that are totally disconnected from the fundamentals of the business. So what we're looking for are long-term compounding businesses that will generate wealth for our clients for many years into the future. John?
Yeah, so building off that long-term ownership mindset, that really guides everything we do. So effectively, we're asking ourselves, if we had enough capital, would we acquire this whole business and own it forever? And when you have that kind of mindset, you really have to narrow your focus down to what really matters over the long term. And so we have really narrowed that down to what we call our three-legged stool. And that would be business, management, and price. So at a very high level, we're looking for businesses with a competitive advantage run by a great leader that trade for an attractive price. And then we use those as our key filters. So we spend all day, every day, reading, thinking, learning about businesses, learning about industries, filtering everything through that three-legged stool mentality. And we're really trying to build what we call our library of knowledge. So we believe that just like how money compounds over time, knowledge also compounds over time. So we're trying to learn something new every single day about a business, about an industry, about a leader, add that to our library of knowledge. And what that does is it builds this foundation that we can then lean on and utilize to make investment decisions when opportunities arise in the future.
That's great. I love that concept of the library of knowledge. It's phenomenal. Andy, you only own 25 to 30 names in the large cap equity portfolio. Some might say that's too few holdings, that's too much risk there. Can you talk to us about how you think about risk and how that relates to the number of holdings in the portfolio?
So in the early days of the formation of this strategy, we decided on 25 to 30 stocks for two reasons. The first is that most studies would tell you that you get adequate diversification from 25 to 30 holdings if they're diversified across industries. The second reason, and equally as important, is the fact that with the extensive research and analysis that we do on every company that enters the portfolio, we want each and every holding to have a meaningful impact on the performance of the whole portfolio. With 25 to 30 stocks, that is the case. If you own 50 to 100 stocks, then that's not the case. As far as risk, we believe that it's the quality of the businesses that we own that reduces risk in the portfolio instead of the number that we own. So we're looking for businesses that have advantaged business models that produce steady and durable cash flows that are financially powerful. And those types of businesses tend to be more durable in all kinds of markets. And so those are the types of risk reduction measures that we use for the portfolio.
John, most investment managers are categorized by either being value or being growth. How does LCE fit into that framework?
Yeah, we don't really think in those terms of growth and value. We fall back on the old Buffett adage that growth and value are joined at the hip. And as business owners, we really need to care about both. So in broad strokes, a company that can grow over time, as long as that growth is productive, profitable, is mathematically worth more than a business that cannot or does not grow. So we want to find businesses that have long-term secular tailwinds that can grow their free cash flow per share, because we want to be owners of those types of businesses. On the flip side, you can get carried away and overpay for that growth. So that's where the value part comes in. We want to be really disciplined about the price we pay, and that really builds in a margin of safety up front, builds in some conservatism. And at the end of the day, when we marry those two ideas together, we use them in combination, that has typically been what has led to some of our biggest investment successes.
Andy, you often say that investing through cycles is something that makes us different. Can you just tell us more about what you mean by investing through the cycle?
So there are a number of different types of cycles in business. There's economic cycles and interest rate cycles, industry cycles, product cycles, and others. And many managers attempt to not only predict cycles, but then try to time those cycles. They want to own businesses during up cycles and sell before the down cycle comes and do that over and over. We just don't think that can be done very efficiently, consistently over time. So we take a different approach. The first thing we do is we avoid businesses that have very deep cycles because we're looking for more consistently growing cash flows. But for those businesses that do have some kind of a cycle, if we're convinced that that business can generate the types of substantially advantaged returns over time, then we're happy to own a business through cycles and through many cycles for a number of years and let those businesses, again, compound our clients' wealth in down cycles as well as up cycles.
John, you guys have written lately about having a healthy level of skepticism in your investment process. Can you tell us a bit more about what you mean by having skepticism as part of the process?
Yeah, so we believe skepticism is critical to long-term investment success, but I would actually start at the opposite end of the spectrum with optimism. We are long-term optimists. Humanity's track record of innovation and consistent progress over decades is unmatched, and we want to harness that. We want to take advantage of that through the long-term compounding of good businesses. But you can get carried away, and we want to avoid blind optimism. So when we say skepticism, we don't mean cynicism, we don't mean negativity, we don't mean pessimism. We really just mean engaging with all of the evidence, engaging with all the facts, seeking out facts and reason that both confirm your views, but also finding things that maybe don't confirm your views, and being willing to change your mind if the facts change. So approaching it with a mindset of examining all the evidence, and that's really driven by just this idea of the future is really unpredictable. We have to stay humble about our ability to know what's going to happen in the future. So we really have to be skeptical and engage with all the facts.
We are witnessing the rapid rollout of AI, artificial intelligence, in our economy. Can you tell us about how we are incorporating AI in our own investment process? Andy, we'll start with you.
Well, we think that AI is likely to improve the efficiency and the productivity of our research process. I go back over 40 years, and when I started in the industry, if you wanted to learn about a company, you had to write a letter, put a stamp on it, send it to the company, ask for an annual report, maybe a 10K, something like that, and a week later it would show up in the mail and you'd read it. And if you wanted to know something about the management, you'd have to go see them. Then along came the internet, and the internet became a terrific tool to improve, again, the efficiency and the productivity of your research efforts, because you had everything that you needed right there at your desktop. All the written information, recorded investor conferences, and so forth. We think that now with AI, you're going to take another big leap in productivity and efficiency of what we can do with our research process. John, you want to talk about that a little bit?
Yeah, I would just say we're still in the very early stages of this artificial intelligence rollout. What we're doing as a team is we are running lots of experiments. We're trying to figure out what areas it's going to add value, what areas is it not going to add value. And my guess is over time that is going to be constantly evolving. A couple of examples, we feel like it's increased our velocity of research. So it's allowing us to turn over more rocks, find things more efficiently, really increasing our productivity for the amount of information that we can ingest. And sort of alongside that, it's allowing us to find more esoteric resources. So a random podcast or an article deep on the internet that provides some nugget of wisdom that was either really hard to find before AI, or maybe we wouldn't have found it at all. So those are some examples, but I would just say also that we're a long way away from AI having any real impact or replacing intelligent human judgment.
And so many things in life, time will tell. But I also like the idea of turning over more rocks and seeing what ideas will stem from that. Andy and John, I've recently heard you talk about the importance of leaders and quality leaders of our businesses. And this idea of, with the great leaders, they surprise to the upside. What did you mean by that? Andy, we'll start with you.
Well, we've had a number of cases where we have done all kinds of research and know a business very well when we invest in it. And then we have a certain set of expectations that may come about in the future. With great leaders, those expectations tend to be exceeded over and over through time. They tend to allocate the firm's capital to the advantage of shareholders. They tend to compound the growth rate of the business at a more rapid rate than we ever figured for a more sustained period of time. So I think in this world of disruption and new technologies, the value of a great leader is more important than ever because of these characteristics that they tend to have.
John, anything to add?
Yeah, if you go back many years, it used to be thought of as that the quality of the business mattered more than the quality of the leader. But in today's world of rapid change, lots of disruption, you really need to have a CEO that can skate to where the puck is going, that can know where to guide the business in a way that a less good leader might not be able to do. The other thing I would add on there is, as business owners, if we're going to own a company for 10 or 20 or 30 years, that company is going to generate a lot of cash flow. And what the company does with that cash flow will be a big determinant in our investment return over time. So we want to make sure that the leaders are doing really intelligent things with that cash flow. And often the best leaders will do things that you maybe didn't even consider at the outset and enhance value in ways that you couldn't have understood in the beginning.
Thanks for unpacking that. Andy, John, thank you for your time. I feel confident that our clients and advisors will have learned something watching this video, and we are so thankful for the work that you do on behalf of our clients.
Thanks, Mark.
Thanks, Mark.